Okay, I hope I'm audible to all students who are attending this lecture of macroeconomics. Okay, if all students can recall that in the previous lecture we had started with the measurement of national income. We had started with the measurement of national income using the value added method, also called as the product method, also called as the net output method. Okay, and if all students can recall that we had looked at the first question, which was regarding the difference between goods and services. We had covered this question in the previous lecture. We had also looked at what are meant by intermediate goods and final goods. Okay. We had also done the difference between intermediate goods and final goods in the previous lecture. Now, in this particular lecture, we intend to look at question 5 and questions starting from question 5. Okay, what are meant by the non-market goods or the non-market activities? Okay, so let's look at this question. Usually it comes as a 1 marker. So when we talk about the non-market goods or non-market activities, these involve producing those goods and services which are meant for self-consumption and not for sale in the market. So when we talk of non-market activities involve those activities pertaining to production of goods and services only for self-consumption. That means you are not selling these goods and services in the market. You are self-consuming these goods and services. So if you look at the example which I have taken in my lecture notes, so for example, if we talk about growing vegetables in the kitchen garden. Now, when you are growing vegetables in the kitchen garden, you are consuming them. You are not selling them in the market. Whatever vegetables you are growing in the kitchen garden are used for self-consumption. They are not sold in the market. So it becomes a part of the non-market activity. Similarly, if you are repairing electrical appliances at home, okay, if you are not a proper electrician, that means if you are doing this just for your own home, if you are not doing this as a job, it's a non-market activity. Now, if an electrician is going home to repair electrical appliances, he is getting paid for it. That is a market activity. But if I am repairing my own electrical appliances at home, there is no market involved here. I am not getting paid for repairing my own electrical appliances. So hence it is a non-market activity. Okay. So we can say that these are the goods that have been consumed without using organized markets. That means, guys, for non-market activities, there are no organized markets. Hence, the non-market activities are not included in national income. Okay, so I hope that students have understood the definition of non-market activities. Point number 1, non-market activities consists of goods and services which are used for self-consumption and not for sale in the market. Point number 2, examples of non-market activities are growing vegetables in the kitchen garden, repairing electrical appliances at home. Okay, so some of these you can think of more examples of non-market activities. Okay, third important point, in case of non-market activities, organized markets do not exist. That means in the case of non-market activities, you are not paid for the good you have produced. or you are not getting paid for the service you are producing. For example, the vegetables you are growing in your kitchen garden, you are not paid for that. The electrical appliances you are repairing at home, you are not getting paid for that. So there is no market involved here. And the last point is, since there are no organized markets for non-market activities, we do not include them in national income, although we should include. Because ideally, guys, these are goods and services produced. So you should add them in national income, but since there is lack of organized market, we do not add them in national income. Now there is a difference between these two statements. You should add it to national income and you are not adding it to national income. One is a suggestion, one is a positive statement, the reality. We are not adding non-market activities in national income because there are no organized markets for them, but we should add them to national income because productive goods and services are getting produced. They should be added in the national income of the economy. Okay. So hoping all students are clear with question 5. Moving forward, let's look at question 6 of the lecture. Who estimates the national income statistics in India and what is the system they adopt? Okay, so students should know this. This also comes as a 1 marker in the exam. So the Central Statistical Organization, which we call as CSO, the short form or the abbreviation. So the Central Statistical Organization estimates the national income in India. And what is the system they adopt? So the national income accounts are prepared in accordance with the System of National Accounts 1993. Okay, so the system which is followed for estimating national income in India is the System of National Accounts 1993. And who prepares the national income statistics in India? Central Statistical Organization. So hoping students are clear with question 6. Moving forward, let's look at question 7. These are all 1 markers which come in the board exams. So question 7, what is meant by capital loss? Okay, so the loss of the value of a fixed asset due to unexpected obsolescence. Now guys, unexpected obsolescence examples would be earthquakes, fires, floods, thefts. Okay, so when your fixed asset is losing its value because of earthquakes, fires, natural calamities, thefts, this is defined as a capital loss. Now, students need to understand that capital loss and depreciation are 2 different concepts. So if I come to the whiteboard to explain this to all students, when we talk about capital loss and when we talk of depreciation, these are 2 different concepts. So when I talk about capital loss, it refers to what? Capital loss refers to the loss of the value of a fixed asset, loss of the value of a fixed asset due to unexpected obsolescence. Due to unexpected obsolescence. The examples we have taken, that is earthquakes, fires, floods, etc. But when I talk about depreciation, depreciation refers to the loss of the value of a fixed asset due to normal wear and tear. Due to normal wear and tear in the process of production. Okay, so when you are using assets like machinery to produce goods and services, over time that machinery is depreciating in value because of normal wear and tear. So in case of depreciation, there is no unexpected obsolescence like earthquakes, fires, etc. Depreciation is a normal accounting process. Every physical asset will depreciate normally over the course of the financial year or the accounting year. But capital loss is not happening because of normal wear and tear. Capital loss is happening because of unexpected obsolescence, like an earthquake or a fire or a flood. So when we talk about depreciation, guys, another important point is that depreciation, so provisions are made for depreciation. Provisions are made for depreciation. Provisions are made for depreciation in the books of accounts. Now, students who have accountancy know this very well. All companies or businesses make provisions for depreciation. That means they take into account the fact that their physical assets will tend to depreciate over the course of the accounting year. They make provisions for that. On the other hand, in the case of capital loss, no depreciation provisions are made. No depreciation provisions are made for capital loss. Why? Because, guys, capital loss is unexpected. Capital loss is unexpected because we don't know when an earthquake will come or a natural calamity will come and physical assets will lose their value or will deteriorate. In case of depreciation, depreciation is expected. Depreciation is something which every company or every business expects over the course of the accounting year. They know that their assets will depreciate in value or lose their value. But in case of capital loss, that is completely unexpected. So since it's unexpected, there are no provisions made for it, but there is insurance. Since capital loss is unexpected, there are insurance companies which provide you insurance against fire, earthquakes, floods, theft, etc. In case of depreciation, there is no insurance. In case of depreciation, there is provisions which are made. Okay, so we can say in this case, capital can be insured. Capital can be insured by buying insurance, to cover against the capital loss. To cover against the capital loss. That means, guys, in the case of capital loss, you can claim the insurance from the insurance company. You have to pay a premium every year for the insurance you have bought. And during the event of damage, for example, if the earthquake comes and your car gets damaged, that's a capital loss. When I have bought a new car today, after 1 year, because of normal wear and tear, it will depreciate in value. That is called as depreciation. But if I have bought a car and an earthquake has come because of which the car gets damaged, that is not depreciation, that is capital loss. Okay, so in that particular case, if I have bought car insurance in the beginning, I can claim the amount of damage from the insurance company. The insurance company can give me the amount of money which can help me to cover against the damage to my car in the event of an earthquake. So I hope all students have understood the difference between capital loss and depreciation. Okay. Coming back to the lecture note, let's now talk about question 8. What are indirect taxes? So again, these are all 1 markers. Okay. So let's look at question 8. What are meant by indirect taxes? So indirect taxes are those that affect the income of the person through their consumption expenditure. That means indirect taxes are not directly affecting your income. They are indirectly affecting your income. When you go to buy some commodity, suppose there is a tax imposed on that commodity. Now, this tax is indirectly taxing your income, because now if you go to the market to buy that commodity, you have to pay more. So indirect tax is going to tax your income indirectly. Examples of indirect taxes, guys. The most famous example we have of indirect tax, I'm writing it on the screen. All students know this tax, GST. It's called Goods and Service Tax. This is called Goods and Service Tax. Okay, so Goods and Service Tax is an indirect tax. Okay, so we have many other taxes. We have custom duties. Okay, custom duties are what? Custom duties are also a form of indirect tax. Okay, custom duties are also, so you can think of custom duties as taxes which are imposed on goods which are transported across international borders. So custom duties, so I can write custom duties are taxes imposed on imported goods. Students can write this as general knowledge. Students should know this, that custom duties are indirect taxes. Custom duties are indirect taxes levied on, these are the indirect taxes which are levied on import and export of goods. These are the taxes which are levied on the import and export of goods. So these taxes are levied by the government. Whatever goods we are importing from abroad, or whatever goods we are exporting to rest of the world, the taxes imposed on them are called custom duties. Sales tax, all of us know, now we don't have sales tax. Similarly, there was something called VAT. If all students can recall another general knowledge, VAT stands for value added tax. These were all taxes which were imposed on goods and services. But now again, if we talk about the current scenario, we don't have VAT as well. If we talk about particularly the Indian economy, we don't have VAT as well. All these are replaced by goods and service tax. Okay, so I hope that students are clear with this. Okay, so I would want to discuss more on the current indirect tax, which is the most important indirect tax. We will be discussing this in our lectures on Indian economy as well. When I talk about GST, okay, GST is the latest and the most important indirect tax which we need to study in our course. Okay, so there are the following rates of GST we have. So if I come to the whiteboard and discuss a bit about the GST. So students of economics should know that GST, also called the goods and the service tax, if you look at the GST rates, they are as follows: 5%, 12%, 18%, and 28%. Okay, so these are the GST. Okay, and in our Indian economy lectures, we will be discussing more on the GST structure in India. So we'll study about the types of GST in India. So basically we have central GST, state GST, and interstate GST. Okay, so if I talk about the types of GST in India, then we have central GST, which we denote by CGST. Then we have the state GST, which we denote by SGST. And then we have the interstate GST, which is nothing but IGST. Interstate GST is denoted by IGST. Okay, so these are the types of GST in India. Okay, but we'll be discussing much more on this topic in our lectures on Indian economy. Okay, but now let me keep it till here and let me come back to the lecture note. So let's come to indirect taxes once again. So if I quickly revise with all students, indirect taxes are those taxes which affect the income of the persons indirectly by taxing their consumption expenditure. So if we come to this line, this is a very important line. You can read this line. You can clearly see that if we talk about indirect taxes, they are levied on the goods and services which people consume and are hence indirectly taxing the income at the time when the income is spent. That means indirect taxes are imposed on goods. When you are going to buy those goods, you are spending your income. That means indirect taxes are taxing your income, but indirectly. Indirect taxes are not directly imposed on your income. Indirect taxes are imposed on goods. When indirect taxes are imposed, they increase the price of goods. As a result, you have to spend more income on buying those goods. This means indirectly your income is getting taxed. So a person can escape paying the indirect tax by not consuming that commodity. You can get rid of the indirect tax by not buying the commodity on which the tax is imposed. And indirect taxes will increase the price of the goods. All of us know that taxes will always increase the price, because when a tax is imposed, you have to pay the price of that commodity. You also have to pay the tax on that. So taxes will always increase the price. And the tax liability of an indirect tax is on the producer seller, but the incidence or the burden of the tax is passed on to the consumer. Okay, so here comes another important thing, guys: tax liability versus tax incidence. So if I come to the whiteboard to explain this concept to all students, so there are two important concepts. One is called tax liability versus tax incidence. Okay, so let's first understand what is meant by tax liability. Tax liability indicates Who is liable to pay the tax? Who is liable to pay the tax? Or the party on whom the tax is imposed. The party on whom the tax is imposed. So tax liability will be indicating who is actually liable to pay the tax or the party on whom the tax is actually imposed. Tax incidence will capture. So tax incidence captures who bears the burden of the tax. Who bears the burden of the tax? This will be captured by tax incidence. Who will actually bear the burden? Now we can say, in case of indirect taxes, tax liability and tax incidence are on two different entities. For example, indirect taxes are imposed on the producers. But they pass on the burden of this tax. The burden of this tax to the consumers in the form of higher prices. Okay, so when we talk about indirect taxes, there are a lot of indirect taxes which are imposed on the producers. That means the tax liability is on the producer. So if I talk about tax liability, the tax liability is on the producer because the producer is liable to pay the tax. But the producer is passing on the burden of this tax to whom? To the consumers, because eventually who has to pay higher prices? The higher prices has to be paid by the consumer. So we can say that the tax incidence is on the consumer. So what we have learned is that in the case of indirect taxes, tax liability and tax incidence are not on the same person. And the example that lot of indirect taxes like GST only are imposed on the producers, but they pass on the burden of this tax to the consumers in the form of higher prices. So producers are liable to pay the tax, but who is actually bearing the burden? The consumer. So hoping that students have understood this and have no doubts. Okay, so if I sum up indirect taxes, what we have learned is that if I come back to the lecture note and quickly revise indirect tax with all of you, so what we have learned is within indirect taxes, point number one, indirect taxes are affecting the income of the people indirectly by taxing their consumption expenditure. They are not directly imposed on income. They are indirectly imposed on the income of the consumer. Second point, we have some examples of indirect taxes, like the most famous and current example of indirect tax in our Indian economy is GST, which stands for Goods and Service Tax. We will be discussing GST in a proper separate lecture in Indian economy. Okay, then we have custom duties, which are indirect taxes imposed on export and import of goods. We have excise duties. Excise duties are also indirect taxes which are imposed on production of alcohol. Okay, so excise duty is also an indirect tax. So excise duty basically refers to indirect taxes which are levied on the manufacture of goods within the country. So again, guys, we don't have excise duties now. Now excise duties are also replaced by GST. So right now in the Indian economy, we only have the goods and the service tax, which is an indirect tax. We don't have sales tax. We used to have sales tax before in India, but now we don't have sales tax. We don't have service tax. We don't have excise duties. We only have GST and we have custom duties. Okay, the third point which we have learned is that indirect taxes are levied on goods and services which people consume and hence are indirectly taxing their income. The fourth point which we have learned is that indirect taxes cause the price to rise. Like any other tax, indirect taxes also cause the price of goods to rise, because now the consumers also have to pay the tax, so they have to pay a higher price now. And the fifth point, which I had explained on the whiteboard, that in case of an indirect tax, tax liability and tax incidence are on two different entities. By tax liability, we mean the person or the entity who is liable to pay the tax. And by tax incidence, we mean that person or entity who is actually bearing the burden of the tax. And the example we have taken is that in the case of indirect taxes like GST, these taxes are imposed on the producer, so the tax liability is on the producer, but they pass on the burden of this tax to the consumer in the form of higher prices, so the tax incidence or the tax burden is on the consumer. Okay, moving forward to the next question. What are meant by direct taxes? Now, if you have understood indirect taxes, direct taxes are very easy to understand. So direct taxes are those taxes which are directly levied on the wealth, property, and income of people. So now, guys, direct taxes are taxes which are directly taxing your income. Remember, indirect taxes were taxing your income indirectly in the form of higher consumption expenditures. But direct taxes are going to directly tax your income, your wealth, or your property. These are paid directly by the consumers to the state. Example, income tax, interest tax, wealth tax, property tax, corporation tax, etc. All of us are familiar with income tax, okay? Then property tax also all of us are familiar with. Tax paid on the property owned. All of us annually pay property taxes, okay? Then we have corporation taxes. Corporation taxes are taxes imposed on corporate profits. Okay, so if I talk about corporation tax, it's a direct tax on corporate profits. Direct tax on corporate profits. Okay, so corporation taxes are the direct taxes which are imposed on the profits of the corporate sector. Okay, wealth tax also all of you should be familiar with. What is wealth tax? Wealth tax is a tax levied on, it is a tax levied on the value of the assets owned. Wealth tax is a tax levied on the value of the assets owned. So what are the type of assets we have? Cash, it's a liquid asset. Bank deposits, we have shares, We have fixed assets like machinery, properties, okay? So these are all the assets. Now the tax which is imposed on the value of these assets is called the wealth tax. Okay, so hoping that students are clear with this. Okay, and then guys, we have something called the interest tax. Okay, so interest tax is also a form of direct tax. Okay, so hoping that students have understood this and have no doubts. So moving forward, let's move forward and let's now talk about the next important point within direct taxes, which is that direct taxes are compulsory. This means that if a direct tax is imposed, you have to pay it. You cannot escape it. Indirect taxes can be escaped by not buying the good on which the indirect tax is imposed. But since direct taxes are directly taxing your income, you cannot escape them. This means that once the direct taxes are imposed, you have to pay them. And in the case of direct tax, tax liability and tax incidence are on the same person. That means in case of a direct tax, the party on whom the tax is imposed is the same party who will bear the burden of the tax. Okay, so if I quickly come to the whiteboard and explain this on the whiteboard to all students, in case of direct taxes, tax liability and tax incidence, are on the same entity. Okay, unlike the indirect tax, where tax liability and tax incidence are on two different entities, in the case of a direct tax, the party on whom the tax is imposed is the same party who will bear the burden of the tax. Okay, so hoping that students have understood this and have no doubts. Okay, moving back to the lecture note, let's come back to the lecture note. Let's now move on to question 10, guys. Now comes the opposite of a tax, which is called a subsidy. Very easy. Okay, so now let's look at what are subsidies. So they are exactly the opposite of taxes. If you have understood taxes, subsidies are very easy for us to understand. Okay, so if we talk about subsidies, subsidies are the payments which are made by the government either to the firms or to the households that provide or consume a commodity. Now, if you look at taxes, taxes are paid by the households and the firms to the government. Subsidies are paid by the government to the firms or the households. Now, why does the government give subsidies? So look at the first point, government gives subsidies to the exporters to promote exports in order to earn foreign exchange. Okay, in order to increase the exports to the rest of the world, the government gives motivation to the producers in the form of subsidies. When the government gives these subsidies, it motivates the producer to produce more and export to the rest of the world, thus earning foreign exchange. Okay, then the next particular reason for giving subsidies, the government also gives subsidies to the firms to sell commodities at cheaper prices fixed by the government. Now, suppose the government decides that certain essential commodities like kerosene, like all the basic food grains. Suppose the government decides that all the basic commodities should be available to the consumer at a cheaper price. But firms will not be able to sell the commodities at a cheaper price. So what does the government do? The government tells the firms to sell the commodities at a cheaper price to the consumers, and then the government gives subsidies to the firms. The government then gives the subsidies to the firms. So it's like saying that the firms are selling to the consumers certain essential commodities. Essential commodities are wheat, rice, kerosene, like the basic commodities, essential commodities. Essential commodities are sold at cheaper prices by the firms to the consumers, and then the government comes, and then the government, so that these firms don't make losses, the government subsidizes. The government subsidizes the firms. When I say subsidizes, it means the government is coming into the picture. The government is granting subsidies to the firms and ordering the firms to sell to the consumer certain essential commodities at cheaper prices. Okay, and another reason for giving a subsidy is that the government also gives subsidies to the firms so that the firms produce more, and more production would mean more employment opportunities, especially in the backward regions. So another important intention for granting subsidies is to motivate the firms to produce more and hire more labor, which in turn will generate employment opportunities and jobs in the backward regions. So hoping that students have understood question 10, subsidies are exactly the opposite of taxes. These are the payments which are made by the governments to the firms or the households. Why do government give subsidies? They give subsidies to the firms to promote exports in order to earn foreign exchange. Government also gives subsidies to the firms to sell certain commodities at cheaper prices to the consumers. These are the essential commodities. Okay. And the third reason for giving a subsidy is to promote employment opportunities, especially in the backward regions. Obviously, when the government will give more subsidy, firms will be motivated to produce more. If they produce more, they will hire more labor, which in turn will generate employment opportunities, especially in the backward regions. Okay, moving forward to question 11. Let's look at question 11, guys. What is meant by the net indirect taxes? Okay, now all of us have just done what are indirect taxes and subsidies. Now all of us know that indirect taxes will cause the price to rise because the consumers will have to pay more when a tax is imposed, and a subsidy will cause the price to fall. Indirect taxes are going to cause the prices to rise in the market. Subsidy, or when the government is granting a subsidy, it means firms will be willing to sell their commodities at cheaper prices because they are receiving the subsidy from the government. If I am the firm who is receiving a subsidy from the government, I will not charge a higher price. I will sell my product at a cheaper price. That means what we learn is indirect taxes cause the price to rise, subsidies cause the price to fall. The net effect on the price of the commodity, which has been taxed as well as subsidized, is defined as the net indirect tax. So guys, you can see on your screen net indirect tax formula. Net indirect tax is equal to the indirect tax minus the subsidy. Indirect taxes are increasing the price of the commodity. Subsidies are reducing the price of the commodity. The net impact on the price is captured by the net indirect tax. Okay. So if I come to the whiteboard to explain this in more depth to all students. Okay. So if I talk about indirect taxes cause the price of the commodity to rise because the consumers now have to pay more for the same commodity. Okay. And subsidies cause the price of the commodity to fall. I can put it in a better way, it causes the price of the commodity in the market. To rise, and subsidies cause the price of the commodity in the market to fall. Because when the firm is receiving a subsidy from the government, the firms will now be willing to sell their commodities at relatively cheaper prices. Now, the net impact on the price of a commodity in the market is captured by net indirect taxes. It is captured by net indirect taxes, and we have just seen the formula in the lecture note. Net indirect tax, which we denote by NIT, which is the short form I will be using throughout my lectures on national income. NIT is nothing but the indirect taxes minus the subsidies. So guys, if I take an example, if the government imposes 10% indirect tax, if the government imposes 10% indirect tax on the commodity, if the government imposes a 10% indirect tax on the commodity and gives a 2% subsidy on the same commodity, what will happen to the price, guys? When the government is imposing a 10% indirect tax, price is going up by 10%. And when the government is giving a subsidy, price is going down by 2%. So I can say a 10% indirect tax implies that price increases by 10% and a 2% subsidy implies that price falls by 2%. So guys, in net terms, my price is increasing by 8%. In net terms, my price is increasing by 8%. So you can clearly see, if the government has imposed an indirect tax of 10%, price will rise by 10%. But if the government has given a 2% subsidy on the same commodity, price will fall by 2%. So if I say that price is rising by 10% and falling by 2%, it means in net terms, it is rising by 8%. So the final impact on the price of the commodity will be captured by net indirect taxes. whether the price of the commodity in the market will rise or fall in net terms will depend on the net indirect tax. So hoping that all students are clear with this and have no doubts. Okay, so guys, this is where I intend to stop in this particular lecture. Okay, what we have covered in this lecture, if I quickly go through it, we have discussed in this lecture, starting from question 5, we have discussed non-market activities, we have discussed who estimates national income statistics in India and the system followed. We have done the difference between capital loss and depreciation. We have looked at the concept of indirect taxes versus the direct taxes. We have looked at the concept of subsidies and why do the government give subsidies. We have looked at the concept of net indirect taxes, which is nothing but the difference between indirect taxes and subsidies. So we have done these 6-7 questions in this lecture. These are very important questions. Most of them are 1 marker. Some of them can even come as a difference for 3 marks in the board exam. So from question 12 onwards, I shall be starting in the next lecture of measuring national income by product method. So in the next lecture, we'll start from question 12. So I hope all students have enjoyed this lecture. Any doubt, you can unmute your mics and ask, or call up or mail me your doubts at divineschoolofelconomics@gmail.com. So this is where I stop in this lecture.